Welcome to the first episode of my Wealthsimple portfolio. Before I start, I'm going to discuss the goals and rules of the portfolio that I plan to follow. If you want to skip ahead to where I just start talking about individual stocks, then feel free to go to the timestamp shown on the screen or in the description. With that out of the way, I want to get into my goals with this series, and my central goal is to create a Wealthsimple account that I can use to create a portfolio from scratch that will emulate an aspiring Canadian investor who's on a budget. I want to show that even with small regular reinvestments, it's possible to build a really good portfolio that will help you achieve your long-term goals. So I'm going to try and make this account something that people can keep up with almost no matter what income they have, so long as they can put aside a little bit. And I'm also going to focus specifically on Canadian securities because I feel like there's a ton of coverage already in American securities, and it's always nice to see more people talking about Canadian stocks just because there's so much out there that really isn't talked about enough on YouTube. It's usually the same 20 or so stocks that everybody talks about, and I think there's a lot more that the Canadian market has to offer. And the last goal that I have with the portfolio is kind of a personal goal. I want to achieve about 12% annually, which is above the 10% historical average of the S&P 500. This would make the extra time that I spend doing research worth the effort over simply investing in a broadly diversified index fund, which there's nothing wrong with, but if I'm going to put in a bunch of extra time and effort, I want to get a better result. So those are the goals of the portfolio. Now let's move on to the rules. And the first rule is that only $100 can be added to the portfolio per month. I can't add less, I can't add more. It has to be $100 per month. Now, we should be sitting on the balance screen right now of the account, and you might notice that I have $106.58. This isn't because I'm cheating or anything like that. This is just poor planning, apparently. If you see from activity, I did put in $100. For some reason, they have a partner bonus here of $6.58. This money has been withdrawn, but it's pending, so we'll see when that happens. I'm assuming it's a one-time thing, so hopefully next month we won't have this problem. Regardless, we're going to assume that it's only $100, or pretend like it's only $100 in the account. Let's move on to rule number 2, which is that I can only set trades on one day each month, but it doesn't necessarily have to be the first of the month. Obviously, some days the first of the month is going to be a Saturday or Sunday when the market's closed, and also sometimes I'm busy on the first or second or third of the month, whatever it might be, and it takes a little bit of time to get these out, and I'd like to put them out generally on a weekend. That way on a Friday I can make my trades, the price will close at somewhere near where that is, and then you guys will get the video probably on a Saturday or a Sunday, just because it takes a little bit of time to do the editing on the audio and whatnot. With that said, I don't have to spend money that I deposit into the account. So if I want to hold cash, that is an option if I don't see any trades that are worth doing, or if I just want to stockpile a little bit of cash in the portfolio. That's not something that I see happening anytime soon, but it's an option that I have, and that pretty much anybody else should have as well. Number 3 is that I can only trade Canadian securities, which I'm doing specifically because I want to draw more attention to the Canadian stock market and other securities that we have outside of the big 10 or 20 that most people know about, like the CNRs and the TDs and the Shopifys. So even though I can only trade Canadian securities, if for some reason a holding in the portfolio merges, spins off, or is acquired, or is otherwise converted into a non-Canadian security, I can still hold it if it's not at a price that I want to sell it at, or I can sell it, but I can't buy more foreign shares. Rule number 4, there's going to be no derivative trading. So this includes Canadian depository receipts, which would basically be cheating anyways. And then also no options trading, no futures contracts or swaps. I think that generally speaking, newer investors are going to get themselves into trouble if they try and mess with this kind of stuff. So I don't want to promote that with this portfolio or my channel. So rule number 5 is that the market cap of all securities purchased must be greater than 300 million Canadian dollars. This isn't because I think companies with small market caps are bad investments, but because I think that even a channel of my size could potentially influence drastic changes in the volume and share price of some of these securities, which, needless to say, if my goal is to help investors, the last thing that I want to do is unintentionally pump and then end up dumping a stock because of the large price fluctuation, which would be a normal occurrence in some of these super small cap companies. But then you add to that the fact that I'd be presenting it to an audience, and I feel like that's just asking for trouble. So the best thing for everyone is probably to avoid talking about these sorts of securities. If one of the securities that I do hold happens to go below this market cap, though, I can still hold on to it, but I'm not going to buy or sell more of it unless it regains the market cap of 300 million Canadian, which isn't a rule that I'd expect most investors to follow. But because I'm doing a public portfolio, I don't want to be considered somebody who pumps and dumps. I'm doing this portfolio challenge specifically to help people. So there'll be a link to the written rules in the description of the video. The last thing that I want to answer is why I went with Wealthsimple over, say, National Bank. And National Bank also has zero commission. And when you're working with such small amounts, you want zero commission because, I mean, if I went with a TD or a Scotia or something like that, I'd be giving away like 6 to 10% per trade, which is not something that we want to do, especially if we want to hold more than just one security per month or buy more than one security per month. Additionally, I've had experience with National Bank in the past, with National Bank Direct Brokerage. I just don't like their trading layout. And on top of that, I haven't had the greatest experience just with their service in general. Also, I think it's important that Canadian brokerages move towards fractional shares. And Wealthsimple is currently the only brokerage to offer fractional shares. And even if it's only in 4 Canadian securities, and none of which I'm really interested in at the moment, I think it's still a good move forward that's pushing a lot of the other brokerages into doing things that are for the benefit of Canadian investors everywhere. I think that more access to fractional shares is a good thing, and I think that more fractional shares over time should happen. Let's get into my first security, which is currently my best idea in the stock market, and that is the Morguard North American Residential Real Estate Investment Trust, ticker symbol MRG, on the TSX. And there are 2 other Morguards that are traded on the TSX. One's an industrial REIT, and the other is Morguard North American Residential REIT's parent company, Morguard. So make sure that when you're looking at this company, it is the ticker MRG, not MRC or MRT. So what Morguard, the residential REIT, does, which we'll be calling Morguard for the rest of the video, is Morguard operates in renting apartment buildings to tenants in Canada and the US. Now, Morguard operates in large cities and urban areas mostly, and a large focus of their Canadian portfolio is on operating buildings in the Greater Toronto Area, which, if you've seen my previous video, is projected to have significant growth over the coming years. They also have a bunch of American properties that are clustered in states that are expected to also see high growth, with Florida and Georgia, as well as Texas and Colorado included in their portfolio, all of which are supposed to be among the top growing states in the US. Obviously, renting is a needs-based business that's been around forever and will likely continue to be around forever, which offers a certain level of industry security that I want when I'm building a central position in my portfolio. But where Morguard really starts to stand out as a great investment is when you take a look at its valuation. Specifically here, we're going to be looking at the tangible book value per share of the company, which, if you don't know what tangible book value is, it's just when you take the total value of the company's assets and then subtract all liabilities, intangible assets, and goodwill. This leaves us with the total amount that the company would be worth if they paid all of their liabilities off and took a loss on all assets that have implied future value but no real current value. Doing this with Morguard would result in a tangible book value per share of about $35.39. But the actual price per share is just under $18, which means that the company is currently trading at a discount based on its current share price of almost 100%. So if we were to buy today, we'd be getting buildings and land for half of the current appraised value, meaning that even if we assumed that the company is overestimating on their appraisals by, say, 25%, and there were an additional 15% crash in the real estate market across North America, we'd still be getting a good deal on the current assets, which offers a strong margin of safety on our capital. What's better is that the company is also profitable and pays a strong 4% dividend and can easily afford to continue paying it. So to summarize, the REIT operates in a needs-based industry, is currently trading at a significant discount to its current price, and has a direct benefit from the future projected population growth, is profitable, and pays a monthly dividend that amounts to an annual yield of 4%. So there are a lot of positives going for Morguard, which is probably why we see a high inside ownership of around 24%. But despite the attractive valuation, institutions haven't really got on board yet. And this is probably due to two things. One is that the market cap is relatively small. It's only about a $700 million company. And then on top of that, this is a company that was spun off from its parent company within the last decade, which makes it appear, at least if you're using a filter or something, it makes it look like the company is much younger than it actually is. And we'll see that the Morguard North American Residential REIT isn't in any of the large banks ETFs or any of the mutual funds or any specific REIT funds, and it only makes tiny appearances in the occasional Vanguard and BlackRock or Mackenzie fund if we look through the the public shareholders sheet. So we can see here that you have the parent company, you have the CEO, but then there's a lot of individual investors and the odd pension fund, but for the most part, this is only making up about 8 to 9% of shares that are held by institutions. So I think there's a lot of room for more institutions to get on board, and there's a lot of room for it to be included more in some of these ETFs and index funds. Now, another thing that I want to note about the REIT is that even when compared to its peers, it's trading at a massive discount when looking at tangible book value. The largest Canadian residential REIT is called Canadian Apartment Properties, ticker symbol CAR on the TSX. And Canadian Apartment Properties generally trades right around its tangible book value. You can see here that the tangible book value per share is about $56 and the current share price is $57.50. So it's trading right around where you would expect it to be at fair value based on its appraisals. And this is sort of the same if you go through all other Canadian residential REITs. It's almost identical, whether it be Killium or Minto or Interrent or any of the other residentials. The cheapest that you're going to find are trading at somewhere over 80% of their tangible price to book value, while Morguard trades at around 50% of their tangible book value. This price discrepancy is even more so the case when you compare Morguard to its US operating peers, where REITs like Equity Residential will trade as much as 3 times its tangible book value, while operating in similar markets. I also did some calculations when doing in-depth research on Morguard from the previous quarter, and found that their average monthly rent per unit actually exceeded Canadian Apartment Properties, and that's based on the amount earned per unit. So you can see here the AMR, average monthly rent per unit, is about $1,473 versus Canadian Apartments $1,130. Now, these numbers might not be 100% accurate because I had to do a lot of calculations converting currencies, as you can see here, as well as calculating individual investments that Canadian Apartments had, where I believe their Irish investment in the Irish REIT, they don't offer the same numbers. So I had to calculate the AMR myself. Now, by buying shares in Morguard, the real cost of getting the equivalent value of a whole real unit would be about $60,000. Here it's $55,000, but the price has gone up slightly since then. Like I said, these are dated quarterly numbers. I do plan on having more updated numbers in a future video if things continue to be discounted. But if you were to look at the actual market in a lot of these areas, you're going to be looking at prices that would cost you about triple, somewhere closer to where Canadian Apartments price per suite would actually be. Though if it's any consolidation, the numbers in favor of Morguard, I believe, have since improved, thanks to 2 properties that were negatively impacted during COVID shutdowns of universities. Since then, the universities have started opening back up, and students who are holding off on renewing their leases are now starting to rent out the unoccupied units again, which is increasing their average monthly rent per unit. Now, of course, there's going to be some discount to the value of shares in a REIT as opposed to real estate units, since you can't live with inside of the shares that might add up to the value of a real apartment unit, obviously. But you will still own the value of the property, and you will still profit off of the tenants in the same way that you would if you were to buy and then rent out the apartment yourself. But you're not going to have any interaction with the tenants, which is probably a plus, though you also won't have the ability to use a significant amount of leverage, which might be a minus. So there is a bit of a trade-off there. You are giving up leverage, but you also have the ability to sell off your shares immediately within a market, whereas otherwise you'd have to list an apartment unit and hopefully somebody would come and buy it, and there'd be a lot of paperwork and stuff, and it might take months, if not a year or so. So to summarize my position on the Morguard North American Residential Real Estate Investment Trust, I think it's significantly undervalued, and it's likely to provide a very good return over the medium and long term. And thanks to its large discount on the tangible book value, I believe that the REIT also has a very low risk of loss on capital, which is what I'm looking for when I'm starting positions within my portfolio. So let's buy our shares of Morguard. we want to buy 4 shares, which should come out to about $71.40. And the shares are currently trading at $17.85. Let's go ahead and buy it. I know how market orders work. Let's go confirm the order. Okay, so we got 4 shares for a total value of $71.40, average price of $17.85. If I go to activity, 1:51 p.m. So that information we're going to keep track of on a spreadsheet so that way we can compare it to the market. We're going to do that next time though, since there's not that much time and I'm going through a lot of these positions for the first time with you guys. So let's move on to stock number 2. And the second and final stock that I'm going to be covering today is going to be Knight Therapeutics, ticker symbol GUD, and it is also traded on the TSX. So what does Knight do? So Knight operates as a pharmaceutical company that acquires, licenses, markets, and distributes drugs and other health products and devices through Latin America and Canada. And one of the main reasons why I like Knight's business is their strategic way that they go about building up their product portfolio. Firstly, the company has minimal debt and stands against taking on long-term debt to fund operations, as you can see here. That said, the company does have about $23 million in current debt on the balance sheet, though this was from an anomalous situation where Knight took on debt to repurchase shares from an activist investor, the Medicine Group, which is a whole story in and of itself that I'm not going to get into here. Regardless, the $23 million in debt is offset by a strong $92 million that the company holds in cash, which for a company that has a market cap of just over $600 million offers a pretty high level of security against bankruptcy. And these financially conservative principles are a staple of how Knight operates throughout their business. When Knight decides to license or develop a drug, the company focuses on ones that are in late-stage testing, and that have a low risk of failure, and that require minimal funding. The company also focuses on acquisitions of already developed, innovative, or branded generic drugs that are usually older or under-promoted and that aren't really worth the time and effort of giant pharmaceutical companies that tend to focus on products that have a much broader demand. This has led to a really diverse product portfolio centered around treatments for various cancers and infectious diseases, and with some more recent exposure to central nervous system and gastrointestinal treatments, especially noting the more recent acquisition of the rights to Exelon, a drug that's used to treat dementia in people with Alzheimer's and Parkinson's. Now, this company is certainly outside of my circle of competence. I don't have a pharmacology degree, and I guarantee you that I can't explain why someone would be administered Haviland to treat their breast cancer over, say, a doxorubicin or any other chemo drug. But I also think that people who are capable of analyzing and determining if Knight's products have an edge in their respective markets are very few and far between. And to remind you, we're talking about a small cap Canadian drug company that has a diversified group of medical products that are offered in different markets, mainly throughout South and Central America. To put it simply, even the people who are capable of analyzing this business with accuracy probably aren't analyzing this business, which, if true, leaves a lot of room for it to be undervalued. Now, before you click off the video and hit dislike, hear me out, because I guarantee you that I wouldn't be investing in a company that I don't fully understand without good reason. And the reason is that the people who are most likely capable of analyzing the stock accurately are investing in it. Specifically, company insiders who have been buying and holding more and more shares over time, which includes the former CEO and current executive chairman, Jonathan Ross Goodman, who was also the co-founder and former CEO of Paladin Labs, a company that used the exact same strategy to build their business from a sub-$10 million company into a several billion-dollar acquisition. So to summarize, the people who are most likely to understand the stock are buying it under the executive guidance of the former CEO of Paladin. The company is using the exact same conservative business model and strategies that worked before, but in an emerging market, which is interesting, but on its own, it's not enough to get me to buy. Where the business really got me interested in buying was when I learned that part of the business involves lending money to biotech companies, usually for rates between 10 and 20%. But more importantly, these high-yielding loans usually come along with exclusivity clauses that give Knight the first dibs should the borrower's product make it through trials and regulatory approval, meaning that in addition to stability and security of the business model, there's an added potential for significant growth without taking on the costly risk of failing during the early development and regulatory stages. Now, if this potential upside were already baked into the stock price, I'd be talking about a different company right now. But the valuation for this low-risk, high-reward potential is what makes the stock so interesting. Knight is currently trading at a tangible price-to-book value of under 1.5, which is offset by the recent acquisitions of Biotscana Investments in 2019 and Exelon in 2021, both of which contributed to large spikes in intangible assets, and thus lowered the tangible book value. However, these acquisitions have led to massive revenue growth in the company. So because of the recent acquisitions and their positive impact on the business sales, I expect that the intangible assets will be amortized over time, and that the growth from these acquisitions should translate into tangible growth on the balance sheet. Prior to these acquisitions, the tangible book value per share was around $7. So assuming that my thesis is correct and that Knight can replicate the strategy and success of Paladin with regards to utilizing capital to make good acquisitions, we can assume that the recent acquisitions at the very least will have a neutral impact on the tangible book value, and that the company should have a real value of $7 or more. If I'm wrong, however, and Paladin's past success was a fluke, and these acquisitions simply turn out to be duds and don't translate into any book value at all, shares would only be worth about $3.58. That means that in a worst-case scenario, barring an act of God type event or fraud or something along those lines, I would lose about 33%. In a neutral scenario, I'd gain about 30%, and in the scenario where I'm right on my thesis, I'd probably have to wait and see how the numbers turn out before I make a guess, because the uncertainty beyond the price of $7 could land us almost anywhere. But the point is that it'd be higher than 30%. Even still, profitability of the company is a bit choppy, and this is largely due to foreign currency exchange issues that come about when operating in countries throughout Latin America that are experiencing currency devaluation. Mostly because of investors pulling capital from emerging markets, but also because of hyperinflation in a couple of the countries. So, to reiterate, the company would have consistent positive net income, but when converting the money back into Canadian dollars, there are times, including the last quarter, in which the company will report a loss. But we're already starting to see some recovery in Argentina, Brazil, and Mexico's currencies. So, assuming that the impact of the pandemic gets better and not worse, and that investment continues to return to these economies over time, these currencies should continue towards stability. But this is definitely a risk worth mentioning and considering for any potential investors. Finally, I want to mention that Knight doesn't pay a dividend currently. However, they are repurchasing shares at what I would consider to be a very cheap price, which is what I would be doing with the money anyways. So I don't really have a problem with that. You might if you're investing specifically for dividends, so that's also something that you'd want to consider. But to summarize my position on the stock, the reason I'm buying is because of my belief that the management, who has a history of success, are uniquely capable of understanding the business and haven't sold any of their shares, not even when shares were trading at over $7.50 during April of 2020. Additionally, the low-risk, high outsized reward scenario does not appear to be considered at the current share prices. All right, so let's buy ourselves 5 shares for $26.38. So we spent $26.40 on shares of Knight Therapeutics, and we spent $71.40 on Morguard, which brings us up to $97.80, which leaves us $2.20 worth in cash that we're just going to hold on to because we don't really want to buy fractional shares of anything that we can buy fractional shares of at the moment. This is how I'd start my portfolio today if I had to restart from scratch with only $100 and had all the information that I have today. But if I were a beginner in the market, I probably wouldn't do this. I'd probably go for a more broadly diversified global ETF, since there can be a lot of pitfalls that even myself, as someone who's been investing for years and years, tumble into from time to time. So I'd recommend using this video as a jumping off point to do your own research into stocks if they interest you. And I would strongly recommend against you investing in these stocks if this video is the only thing that you have to go off of. I consider this video a summary of the reasons why I would invest in these companies, but the information in this video in no way includes all the factors and nuances that might lead you to make a different decision, or even myself to make a different decision. I'm sure there are factors that if I know about might change the decision that I made today. There's a lot of information out there that's available to people that I think you should check on before you decide to make any sort of buys or sells in your portfolio. Yeah. Enjoy the rest of your day. So that's my video. This is how I would invest my money if I were a beginner in the market today. Hopefully you enjoyed this. Hopefully it gave you a little bit of insight into what I do when I'm looking to invest in a company. You probably noticed a bit of differences between the two stocks of how I went about it. And that's because I think that every company you need to evaluate differently. I don't think any two companies are the same. And so I don't think you should use the exact same metrics to evaluate any company. With that said, I hope you enjoyed the video. If you think anybody else could benefit from this video, please share it with them.